In this video, I'm going to explain what a health savings account is and how it can help you save money. Hi, I'm Sean with Families Creating Financial Freedom, and in this video, I'm going to discuss health savings accounts, also known as HSAs. A lot of people don't know what they are or how they can benefit from them. I'm going to break it down for you. Very often, we're talking about debt elimination on the road to financial freedom, but remember, also, efficient savings is very important to achieving that goal. A health savings account is an excellent way to save for surprises while creating tax efficiency, which ultimately increases the bottom line of your income. Many people don't know what a health savings or HSA is, why they would need one, or how they work. So I'm going to first explain what it is, and then I'm going to give you 3 pros to having it and 2 negatives to watch for. An HSA is basically a savings account that is earmarked for medical expenses. When I say medical expenses, anything that is out of your pocket. Currently this year, the IRS allows you to contribute $3,650 per person or $7,300 per household and deduct it from your federal income tax, thus creating efficiency in your savings. The offset is it is earmarked for medical expenses. So 3 positives. First, an HSA allows you to put money in the account that you're earmarking for out-of-pocket medical expenses, and those contributions are tax deductible. This is extremely helpful as it is normally nearly impossible for the average household to reach the threshold of medical expenses to deduct from their taxes. On the other hand, with an HSA, you can deduct a much lower amount of money. Second, typically, you open an account and receive a debit card that you can then use when you go fill a prescription or you go to the doctor's office to pay for that visit or that prescription. If that facility doesn't take a debit card, you can generally pay out of pocket, get a receipt, and send it to the HSA, and they will reimburse you for that expenditure. Here's the third beautiful thing about an HSA. Unlike a flexible spending account, which you open up through your employer, an HSA can be owned outside of work by you, and what you don't spend that year that you've contributed can roll over. Many HSAs will allow you to continue to roll it over, and after you have exceeded a certain amount of savings, they will allow you to invest some of that money so that it grows outside of you simply contributing. The fact that you can roll it over year after year is wonderful when you go into retirement to help offset medical expenses down the line when you're potentially on a fixed income. Very beautiful feature. Now, nothing is perfect, but an HSA is excellent so long as these things don't factor for you. First of all, you have to be in what they call a high deductible health plan. More and more employers are switching to high deductible health plans as a way to reduce premiums not only for you, but for them, the employer, if they're paying a portion. What qualifies as a high deductible health plan? Well, you have to have an individual deductible that exceeds $1,400 or $2,800 for a family. Again, $1,400 or $2,800 for the family, and out of pocket cannot exceed $7,050 per person or $14,100 for the family, meaning you have to spend $1,400 before your health plan covers anything, and once it does, you can't spend more than $7,050 before it takes over paying 100% of your medical expenses. So again, you have to qualify by being in a high deductible health plan to contribute to an HSA. Some people actually may have an HSA, go with an employer, not be in a high deductible plan. They can't contribute. The HSA continues to sit there. They can use that for expenses. And then if they change employers again and the next employer is in a high deductible plan, they can continue contributing. Also, if you are looking outside, as in self-employed at health plans, you'll find that high deductible plans tend to be much more affordable for you, the individual, which is why they are becoming more and more popular, and HSAs are becoming also more and more popular to take advantage of. The problem with being in a high deductible healthcare plan and leveraging an HSA is, what if you have high medical expenses as a reoccurring thing? If you have chronic health issues where you're going to far exceed what you're allowed to contribute, or even just what you contribute to an HSA, it may not be as functional as being in a traditional health plan. So don't always think it's the best scenario, but if you are in a high deductible plan, please, you want to take advantage of an HSA. The other negative about an HSA is what you put in must be used only for healthcare expenses. If you take a withdrawal and use it for something other than a medical expense, the IRS will penalize you 20% on top of making you pay income tax on that withdrawal. So it is, once you put it in, it is earmarked for medical expenses without exception for anything else from then on. I think the positives far outweigh the negatives with an HSA. I also recommend that if you qualify for one, a lot of employers will offer one, or it'll be bundled with your health insurance. You don't need to take advantage of it that way. Go outside of your employer and open up an HSA. Why do I recommend that? You tend to find better plans outside of employer provided. And two, in today's society, people tend to change jobs. It is easier to not lose track of your HSA if you own it directly than if you take advantage of it through your employer. It's something you don't have to roll over or move. You can open it, establish it, contribute to it, keep it without all those interruptions or nuisances of going through work. Now, I hope I've explained an HSA and you have a full grasp on the advantages for you and if it is something you can take advantage of. If you have other questions, feel free to go through my website and reach out to me. I'm happy to help you or discuss this further. And until the next video, take care.